Hello and welcome to this week's market outlook for the Monday of October the 12th. This is Jeff Bish, president of MarketGauge.com, and I am filling in for Keith, who usually does our weekly market outlook. And what you're looking at here is the image or similar image that you probably just saw in the blog post. If you're just finding us on YouTube, make sure to subscribe to our channel and also make sure that you go check out the blog post. You'll find it at marketgauge.com/tutorials or in the Outlook section of our website. Also, follow us at marketgauge.com, where I will continue to post more information along the lines of these types of statistics that seem to sway the market. And when I say these types of statistics, I'm going to dig a little bit deeper into the day of the week and how the day of the week impacts whether or not the market is tending to trend up or trend down. And some days you just want to stay away from, and some days there's definitely a bias towards gaps and a bias towards the move from the open to the close. So as I said in the article, there are definitely some shifts that have happened in 2015, and also there are certain days you want to avoid. So I'm not going to spend a lot of time with it in the video, but there's more that I can show you in a video than I can explain in the text. So just quickly, one of the things that I want to point out with the luxury of a video is how the days of the week can tend to trend from being bullish or bearish, right? It isn't about just being a simple system of buy one day, sell the next, and then that's all you have to do and you're set for life, right? That's not the case. But there are times when you definitely can come into the week and know that certain days have a distinctly more bullish or bearish bias than the other days. And so let's just take a look. This top trade here is looking at the gap from one day to the next for a specific day of the week. And the bottom chart here is looking at the distance that the market travels from the open to the close. And the dotted white line represents the summation of all days. So each one of these days, each one of these lines is a different day of the week. And so you can kind of figure out how the colors work because these numbers are listed in the order of the day of the week. So the first one is Monday, then Tuesday, then Wednesday, then Thursday, then Friday's in yellow, and then the white again is the summation of all of them, and that's the dotted white line. But you don't necessarily have to know each one. What I want to point out is the extremes or the trends that exist. So the green here is Wednesday from the open to the close. So you can see that it had a bullish trend through, not Wednesday, I'm sorry, Thursday, through about July. And during that time, the gap of into Thursday went from being a tendency to gap up to a slight tendency to gap down. And then around July, it started to tend to gap up and then to trend down during the day. Now, one of the things that I don't have time to go into today, but there seems to be a tendency that when Thursday starts to get weak intraday, it tends to precede major drops, not necessarily crashes. You can't always be sure that it's going to crash, but into the crash, Thursday was becoming a weak day. Wasn't gapping up much, and it was starting to get weak. But on balance, Thursday had been a great day. Now, the other interesting thing is what happened after the crash. A couple of days really changed their complexion. So after the crash, look what happened to the gaps on Wednesday. Ever since the crash on the 24th, Wednesday has gapped up every single day. Not always by a lot, but every single day it has gapped up. It has not necessarily moved up after the gap. Some days it did, some days it didn't. But on balance, it's been a positive day but primarily because of the gap. And not only that, since that crash, Thursday started to become a strong day again. All right. So uh, that's what I was trying to highlight in the text leading into this. Wednesday and Thursday together have really been blockbuster days, and you really wanted to avoid Fridays altogether. All right, so the other thing I can do in the video here quickly for you is let's take a look at a longer period of time. All right, so I did compare it to the move from the low of the bull market in the text, right? I compared and contrasted it from the low in 2009. So just to give you a little bit more color, again, looking at how markets have tended to trend, one of the things that I thought was an interesting observation, and it really started back here in the last October crash. So this data stopped at the end of 2014. But look what happened after that bottom in 2014. Thursday again, right? Thursday became a strong day intraday. All right. Leading up to that, Thursday was getting weak. All right. So interestingly enough, if I go like this bottoms out. Thursday has a modestly bullish bias. It starts to get weak, and the market gets weak. All right. Wednesday, again, a strong day along with a strong day when Thursday was getting weak. Now, in this case, when the market was moving up, Friday, the yellow line was actually in a bullish trend as well. Friday isn't always in a bullish trend, right? So the point here is that the days of the week that get strong, I think, can give us indications of what's going on in the market, and it's worth, especially if you're an opening range trader or day trader, or you're a swing trader looking to time your way in. Look at some of these time frames where in this time frame here, the Tuesday was really strong. Right now, Tuesday is the day that in 2015 that has been the day you absolutely wanted to avoid. Yet it goes through these extended periods of being strong, these extended periods of being weak, these extended periods of being strong. All right, so I'll be covering more about the different patterns that we find in here. There are lots of great patterns, and like I said, from a day trading perspective, I think this is an interesting edge. From a swing trading perspective, it could help you time your way into it. And if it begins to feel like, you know what, Mondays are always a tough day, or Wednesdays always seem to be a tough day, or Fridays are a tough day, it may just be that you're not imagining things, that the market really has that underlying structure to it. Now, there may also be reasons for this. In the past, I'd heard and read about certain days of the week being stronger during QE because there was QE going on more so in some days of the week than others. I don't know. There could be lots of reasons, but for now, it's easy enough to observe, and it's quite powerful. So I hope you've enjoyed that. Let's get to what I would call the regular portion of the market outlook, where we look at the markets in general and what they might have in store for the upcoming week. I have a couple things that I want to focus on, and I won't make it too long. And I'm going to talk about the actual position of the markets at the end. First, let's look at some of the indicators, and we usually do it the other way around, but there's a rationale for my madness here. So I'm going to look at three different indicators. I'm going to look at the McClellan, I'm going to look at the VIX, and I'm going to look at the new high, new low ratio. That's it. Then we're going to look at how those all add up and where they and when you have to start worrying about the markets on the upside or the downside. So if we were to just look at the McClellan, which would be easy to do, we would look at it and say up here at 274, we have not seen this overbought of a market in a very long time. got close in October of 2014, and it got very close in July of 2012. And I say very close. It was, just a few points away. So 274, we have to go all the way back to 2010 to find that kind of overbought reading. Now, the one thing with McClellan, if you look at this data closely, is it is a very kind of short-term overbought condition, and it's often early. So just because it's overbought right now doesn't mean the market has to go down. And the other thing about markets is after you've had a big move to the downside, right, which I'll describe this as a pretty big move to the downside for us, you really want to see a market get overbought, all right? It's a resumption of breadth, it's a resumption of strength coming back into the market. So it's actually a good thing. Sometimes it does mean it's just exhausted, it's going to roll over and go straight back down, but not always. So for example, after the last October, the last sell-off, the biggest one that we've really seen prior to this, you can see that McClellan got overbought and then more overbought and then almost as overbought as right now. And even at its peak, it still had quite a ways, the market still had quite a ways to go as the McClellan fell apart. So when I say that it's not it's a very short-term overbought, it means that the market can easily get to this overbought and pull back without the price action really reflecting it. So what you want to do is make sure that you recognize the market's overbought here, meaning the breadth might be exhausted, the trend to the upside could slow down, and if the market action starts to turn over and fall apart, then this becomes much more significant. So it is significant to know that it's here, but we want to make sure we confirm it with the price action, because there's actually other indications that could suggest that maybe the market's just getting started here. But before we look at that, let's take a look at the VIX. Right, so one of the things that we look for in the VIX, and if I were to just look at the VIX without the Bollinger Bands, I could easily say, the VIX is still pretty elevated here from the levels that it had been at. But it's also pretty low relative to its Bollinger Bands, right? So when it comes back down to that lower Bollinger Band and then turns up, it's often an indication that the VIX is oversold. And if the VIX is oversold, it means the market's overbought. So this confirms, or I should say is coincident with the McClellan oscillator suggesting that the market may be a little bit stretched on the upside. And if it starts to roll over, if the market starts to roll over, VIX could easily shoot back up. And that would be indicative of there being more fear to the downside. So the important takeaway from the VIX is that we're at the bottom of the Bollinger Band, and oftentimes when that's the case, the next move is up. Doesn't mean we necessarily have to go back up to the highs and the market has to go to the lows, but it may mean that the market's a little complacent here on the upside. Now with the earnings season, it makes it really hard to time things because there's so much news that could rock the markets in any given day. But let's not just think that the VIX is elevated because it's at 21 or 22, because relative to where it's been over the last 30 days, it's not elevated at all. That's the takeaway from here. All right, so if those two indicators are indicating that the market may be a little overdone on the upside, here's one that's suggesting perhaps it's just beginning on the upside. All right, so this is one of my favorite market breadth indicators, and it's at one of my favorite spots. This is a new high, new low ratio in which we take the number of new highs and divide it by the number of new highs plus the number of new lows. Now, the best way to read this is to look for situations where it's coming from a top and rolling over, or it's coming from a bottom and moving up. So from a top would mean you're going from over this 90 level, 85 level, and then fall below the 70 level. And that's when the market is indicating, you know what, maybe it's gotten a little overdone and now it's getting weak. And then you want to follow it along with the trend of it at the time. Now, the opposite is true near the bottom. Once you drop below this 20 level, then it's really in a bearish trend, and the resumption of a bullish trend or the beginning of a bullish trend happens when you get over the 30 level, which is what we're just doing now. However, there's one thing else that you don't see in this chart that you do need to watch out for, and that is you want to keep an eye on how many new highs are being created in order to make this happen. So in other words, if you think about it, if you have 10 new highs and 5 new lows, that means you've got 10 over 15, and that's creating your index. That's certainly not the same as having, say, 100 over 150, where you've got a lot more stocks indicating. Now, what you want to see is you want to see this turning up with a substantial number of stocks. So right now, I think the number on Friday was 60, 62 in New York. I mean, that's a lot better than what it has been, which has been down near 20. But really, we want to see the new high number up over 100. So if we start getting 100 new highs and this thing trending higher, this could be telling us that this was a real bottom, intermediate term, if not longer term bottom. All right, so when I say this doesn't really jive with the McClellan, that's what I mean. That said, McClellan and the other indicators could have this pull back, indicate this is going to pull back in here. As long as this holds up and then starts to trend higher, then they could wind up both being right. All right, what we don't want to see though is if the market pulls back and have this new highs completely fall out of bed and this head back down under 20, that would be bearish. All right, now that's kind of the background. What you now want to look at is what's the market doing? All right, so let's take a look at what the markets are doing. And here again, I'm going to keep it really simple because that's the way I like to look at the markets. And if we use the SPYs as the example, they're all pretty similar. The key points here are you've got your 50-day moving average, which in this case the SPYs have breached and closed above twice. The next big point here is the top of the range that's created by the consolidation before the Fed broke out. And in the SPYs, we're above that. We still have to get above that Fed spike for sure, and then we're going to run into these levels of resistance. But remember, the question here is, are we overbought and we're going to roll over, or are we going to continue higher? As long as it continues to plot higher, it's got a lot of resistance to get through, but I think you got to follow it to the upside. Where you get worried, there's three things that I'll watch out for to start to get worried. First is we trade in a significant way below the prior bar's low. Now, if you'll notice, since this low, we've only broken a prior bar low once, right here, not by much. It was on an open and immediately rocked back to the upside. Every other day, we've just continued higher. The next thing I want to look for is a close below the prior bar's low. That would make me more bearish, at least in the short term. And then the last thing would be to close below the green line here, which is the 10-day moving average, and then move lower. And it's at that point that I will start to think, okay, let's not forget about the fact that the VIX did get pulled down. Let's not forget about the fact that the McClellan did get overbought. All those things indicate that it was running out of steam, and now the price action is telling us that it is in fact running out of steam. But what could easily happen is a pattern that has pretty much developed in the Qs, where the Qs, while they haven't gone straight up, they have kept with the same basic pattern that I've talked about, right? They haven't taken out prior lows by much, and in the process, they had a rest of 2 days here. They've now had a rest of basically 4 days here. Markets get a rest, that's all they need to move higher. Now, Qs haven't really taken out the highs prior to the high, the consolidation that the Fed day kind of broke out of. They're just breaking above their 50-day moving average, and now they're into the resistance of the 200-day moving average, and this is heavy resistance in here. But they've had a rest. They're one of the strongest groups, one of the strongest indexes, and with another half a decent day, it's going to be back over the 200-day moving average, much stronger than any of the other ones. So while the Qs have kind of been plodding along a little slower, they started off in a better spot. They've rested. So when you get an overbought situation, sometimes overbought gets worked off by sideways action. So here again, we want to wait for really the negative action before I get too worried on the downside. All right, and finally, if we take a look at IWMs. Now, IWMs have been the weaker ones, but really IWMs have the best indication that maybe this market has in fact bottomed out because they took out their crash low and they've bounced back up to the 50. All right, you can see they're also flirting with a really important trend line. And so if the if the IWM continues to move higher, it's actually got the best looking bottom. Again, it's really easy to see when the market starts to roll over. If it does, this would be a great place for it to roll over, and we need to be really careful. Look for support down near the 10, and just follow the market. And of course, now that you know which days of the week are the best days to look for the market to be weak and the best days to look for the market to be strong, focus on your longs on those days and your shorts or your vacation on the days when the market's not that strong. Hope this has been helpful, and I'll see you in the next video.